Hello, I am Frederick Bell, CEO of Elemental Altus Royalties. We are a TSXV listed precious metals focused royalty company, and our unique attribute is that we, for a company our size, we have about 10 producing royalties and diversified revenue from the outset.
Good to see you, Frederick. We saw you back in June, but bit of news. There's a flurry of news coming out of you at the moment, and you've been doing a little bit of spring cleaning in Ethiopia and Mali, and finishing things off with the Caserones project as well. So, can we start with Caserones, if you don't mind? Because that was, I guess, the last thing we talked about. What's been happening there?
Yeah, so I think since we last caught up, Matt, we acquired another part of the Caserones royalty. And so we just upped our interest in that royalty there. And coincidentally, it was shortly before Lundin Mining closed their acquisition of a majority stake in the mine. And I think that increased our confidence in the asset going forwards, and our belief that in the medium term going forwards, Lundin are going to be able to bring their synergies in country, operationally, and technical expertise and exploration knowledge to bear at the asset. And I think just at a high level, Caserones, it's had a pretty long mine life. It's a large copper porphyry, but it hasn't had a lot of exploration in recent years. And Lundin have been very active in exploration in that region in recent years. So I think they've spoken publicly to the fact that they see a lot of potential exploration upside at Caserones. And for us, that's a long cornerstone royalty that is paying today, and we think will be paying many, many years into the future.
Right. Okay. So you're sitting at just under half a percent there. Is that right?
Yeah.
Something like that. Okay.
Yeah. And look, it's you know, those kinds of assets that I think you could call sort of generational assets. It gives us uncapped upside to the copper price primarily, to exploration upside, to technological improvements as they go. And I think the way the market has been, going, and the electrification theme, copper is going to continue to be in demand, and existing operations like Caserones that have had billions of dollars spent, and many years to get them to this point. It's rare for a company our size to have really high quality royalty on an asset like that, that's shared by some of the bigger royalty companies as well, like Franco-Nevada. So it's certainly a good quality asset in our portfolio, with a long mine life ahead of it and a lot of exploration to come.
Right. So those are the kind of the blue chip parts of the portfolio. You've kind of got an extensive portfolio, and you've been looking at. Well, let's start with Ethiopia in terms of what's happening there, because I'm interested in this, how you manage and how you optimize your portfolio. When do you exit or monetize assets? How do you work out how long you hold these things for? So, if you don't mind, Ethiopia, what have you been doing there?
So Ethiopia, we just announced a deal with ANS, and we were familiar with some of the principals there, both from another company. Some of them are involved with, and previous sort of businesses, and very good management team, really good technical knowledge. And really, we were looking for a partner to take Ethiopia on over the next couple of years, and really be focused there on the exploration opportunity. And that's a deal where we see cash up front, we see staged payments, we keep 5% equity interest in the company, and we have an equity interest when that company lists at the parent company level. So for us, really in this market, I think it is partnering and outsourcing some of the exploration. We have taken some of these projects to the stage they're at, and some of them have taken years to get here in terms of target selection, refinement, getting the in-country set up. And it's at a stage now where if we can put it into really good quality hands who can then advance a project, that's the best outcome for us in terms of outsourcing some of the ongoing expenditure, and also keeping our uncapped interest through a royalty alongside cash and equity.
Right, but the selection of the groups that you use, because you could sort of spin this out and not do too much thinking about it, because all companies are equal. They're not. Just because you want to kind of need the short-term cash, but you've got to believe that the team's capable of raising the capital and have got a plan to actually get this thing into production, because ultimately there's going to be phased payments, but at the end of the day, it's the NSR on these things which are the real value. So again, how do you do that diligence on the company? What gives you the certainty or confidence?
Yeah, I think you hit the nail on the head there when you say that the sort of cash element it's more of almost call it a cost recovery element, and we're recouping some of the expenditure and some of the money we've put in. But the real upside is in having an uncapped royalty on that asset in the future. And the more of those we can get, and we've got 15 in Morocco now. We've generated. We have 2 in Ethiopia with this deal closing. We've got the recent deal in Mali where we have royalty now. We'll be going forwards on Dibala Kampfler. That is where the real value is, because some of these assets, in Mali's case, it's going into production soon. So that will have a real immediate value, but it will also have very material and not as defined value, but going forwards on the exploration upside. And for us, I think if you want to talk about how we partner with people and how we find them, I think the transaction, which we also just very recently announced in Mali, with Allied Gold is a great example. And that was a 600,000 ounce project. We had Dibala Kampfler adjacent to Allied's operating Sadiola mine. And for those who don't know, Sadiola was a 10 million ounce resource historically. And with the sulfide potential to come into production, got the potential to be a tier 1 asset going forwards. And at the moment, it's largely an oxide mine, and we have near surface high grade oxides adjacent. So we sold it to Allied for upfront and staged payments of $6 million, which is great in cash. But the real value for us is the royalty. And I think Allied's plan is to get that, and they've said this, to get some of that oxide through the plant as quickly as possible. So, call it 5 million of revenue in 2024 and 2025. And then there's double that resource again to be drilled out from the inferred stage. And they're in the right place to do it. And why are they in the right place? Why did we do the deal after a competitive process with Allied? The obvious synergy was they had an operating mine 12 kilometers away from the resource. They have their own drill rig. They have their own exploration team who have been there for years, who understand the geology. And again, that project is at a stage where, you could quite easily put a couple of $1 million of exploration into it straight away. And they're in a position where not only can they do that, but they can do that simultaneously, bringing it into production faster than anyone else, because it is on a small-scale mining permit and adjacent to their mine, and get it straight in. So in these cases, we're trying to look for the teams that not just have the technical capability, but in this market, have the financial ability to progress it. Because, we're a roughly $200 million company, and we're looking at the expenditure requirements going forwards on some of our projects and saying, well, to do the next stage well, we'd want to be committing $1 million, $3 million, $5 million to really add value. And actually, is that for us in our position as a royalty company, is that the best use of our capital? Or should we find a really good quality partner who's financially capable, who has the technical expertise, and they can take that and make that multi-year investment, and we can get cash payments, equity carry, and royalties. And that's what we've done in both the case of Mali and Ethiopia.
Right, and obviously very different profiles. I mean, Allied Gold versus NS Exploration, companies at different phases of their own growth story. But you make an interesting point there with regards to picking the right companies, in the sense that the royalty doesn't go away. Like, say, for whatever reason, if a company that came in and picked up one of your assets, whatever the deal structure was, if that didn't work out for them, your royalty remains. It doesn't go away. It's the royalties on the asset. That I think that's interesting for people to understand and recognize. What it does do is destroy the time frame, and therefore the return profile of any investment you've made to date. So it's a big thing, picking the right company, but how quickly they can move through the phases is also quite interesting. And I see that in Mali and Ethiopia, two very different profiles there.
Yeah, and talking about the royalty sort of being there for the long term. I mean, again, I think if you use the case of Mali and Allied in particular, that is in terms of resource, it's a 10 million ounce resource. And that's historically information that's out there. And there are not many of those around. And I think deeper capital licenses essentially will be part of that mine now, and we will have an uncapped 3% and then 2% royalty on part of what is a 10 million ounce plus operating mine complex with a, call it order of magnitude, $1 billion operator, multi-mine operator. That for us is a fantastic result. I think the exploration upside and the resource that they have at Sadiola, there's every possibility that it continues on strike into parts of our license. But again, it is that is exploration work that you need a couple of $1 million on just to take it through the next stage. And for us, I think we can most cost effectively realize the benefit by partnering with someone like Allied who understand the geology intimately, who have been there for years, and who have the ability to really fast track it into production at the same time as exploration. And so that royalty for us, that sort of deal for us, $6 million up front, plus maybe $10 million of sort of payments in royalties over the next 2 years at a top level. And then beyond that going forwards, I think that's a really good outcome to have. And I think that royalty could quite easily be producing for a number of years into the future, as Allied both upgrade the resource and define more.
Right. So tell me this. We've been talking for a couple of years. We've been following this story and that growth. You must have learned a few things in the last couple of years in the sense that it's been obviously a very, very difficult market, but you've done a few things right. The merger made a lot, well, defense of a takeover, let's start with that. Then because you didn't feel it was the right profile for your shareholders or your company, the merger that's gone on, and then now this kind of, I guess, pruning or optimizing, let's say, of the portfolio. In terms of what you think is important now versus what you thought was important maybe 3-4 years ago, where's your head at in terms of where the kind of next kind of inflection point for your company comes from?
So I think that for us, look, it's always a balance between the opportunities that we're looking at on the royalty side, and particularly in the situation we've been in the last year, is we felt we had a huge amount of, call it, latent value in our portfolio through Mali, through Ethiopia, and we still have Egypt, very large land holding in Egypt. And I think for us, it was how we can maximize the value there, bring in partners, and particularly in this market where I think our view is that cash is king, and there are a lot of good projects and there are a lot of good companies in the exploration development phase who are trading at discounts to where they've been in the last 2 years. And I think our view is that, again, if we can find good quality, financially strong partners who can, put some of the risk capital to work and advance these projects, and crucially give us a good royalty on them going forwards, that's a really good way for us to maximize value and minimize our ongoing investment in the future. In terms of the royalty opportunities, I think we'd characterize it that in the last 2 years, royalties often move sort of counter to equities in terms of opportunities. And I think that in this market, we are seeing a lot of good royalty opportunities for our investment. So there's a lot of competition for our investment dollars. And conversely, we want to be cautious in how we deploy those dollars and make sure we're doing it accretively in the context of where our valuation is as well. And we're fortunate in that this is what the company was really built for, which was in a downturn to be cash flow positive and to have ongoing funds to reinvest when no one else does. And some of the best opportunities are out there. And if we can be doing that in parallel with really, I think, realizing and demonstrating value in our royalty generation portfolio by attracting high quality partners from a technical and a financial standpoint, it puts us in a position where looking forwards, we've outsourced a lot of our exploration expenditure to partners, and we've got that money to deploy into a market where valuations are increasingly attractive.
and
that's sort of, I think, where we find ourselves.
Yeah, well, for sure, some very, very attractive deals to be had. But cheap doesn't necessarily mean good. So obviously you've got to focus on the kind of the quality side of things and do that diligence. Otherwise, it'll come back to bite you further down the line. In terms of the kind of fun and games that we saw a couple of years ago with new entrants into the marketplaces and valuations perhaps being slightly out of whack with the reality of their balance sheet. Are you seeing things like calming down? Do you expect to see more M&A in the market, or are people just kind of focused on trying to get either generate royalties or buy royalties, or what's the kind of mood out there?
I think our feeling is that we'll probably see more M&A both in the mining space generally, but also specifically in our royalty space. It's likely there'll be continuing to be M&A this year and going into next year, and that might just be a reflection for the whole industry. But it's this is not the first time it's happened. If you go back to 2014, 2015, there were roughly sort of 10 M&A deals, and the royalty space consolidated, quite a lot in that period. And coming out of that into sort of 2016, 2017, you sort of saw new royalty companies being formed, and I think it peaked in 2020. And since then, we've seen 6 or 7 M&A deals in the royalty space, and I think we'll continue to see that over the next year or two. And so it's a sort of, I think it's almost a repeat of a pattern from that. I'd call it 2010 to 2015 period is almost repeating now in the sort of 2017 period to 2023 period, where you've seen the smaller royalty companies be acquired in M&A. And you've seen a gap in the small side, and then you've seen new companies come in, and then there's been a lot of competition and high equity markets, and then you've seen consolidation in that space. And so we're going back to the phase where there are probably more opportunities in the market, and there are less royalty companies there, particularly in the sub-billion dollar space.
Yeah, interesting times. Well, nice to see this kind of the flow of information kind of coming out of the company with regards to that kind of manicuring of the portfolio. Stay in touch. Let us know how you get on, obviously, with any more deals that you've got planned, and we'll speak to you soon. Okay.
Much appreciate it. Thanks, Matt.